Hi, everyone. We'll start shortly. We're just waiting for others to enter. And while we're waiting, I'll just be sure that you know that there is a Q&A. It's if you don't see the Q&A at the bottom of your screen, you want to click on More. And when you click on More, you should see the Q&A there. Just open that and type your question in at any time during this town hall. We'll answer your questions at the end. Well, welcome everyone. I'm Charles Buck, President and CEO of United Church Funds, and I'm very pleased that you have joined us today for the latest installment of our client town hall meetings. Quick reminder that these town halls are for information purposes only. Nothing said or presented here should be construed as giving any kind of specific legal, tax, investment, or financial advice. If that's what you're needing, we encourage you to seek out a qualified professional. Before we move on, I want to point out some churches here in this slide. Today we're featuring two prominent churches in Atlanta, Georgia. At bottom left, you see First Congregational Church, United Church of Christ, which will be celebrating its 160th anniversary next year. The Reverend Dr. Dwight Andrews is pastor, and one of the church's ministers is the Reverend Andrew Young, the former U.S. ambassador. In the bottom center, next to it, is the sanctuary of Central Congregational United Church of Christ. And you're looking through the windows into a real nature preserve. It's a sort of sanctuary within a sanctuary. The Reverend Elizabeth Mitchell Clement is designated senior minister of Central Congregational. UCF is honored to serve both of these landmark churches in Atlanta through the stewardship of their assets, just as we are honored to serve all of you here today. If you'd like to see your church at a future town hall, drop us a line or send us a photo. Let's go to the next slide. I want to start off with a quote. Michael Burry said earlier this week in the we are witnessing history, he said. We are witnessing history in the stock market. That is not a good thing. And Michael Burry may be someone worth listening to. He was the investor who predicted and profited from the 2008 global financial crisis. It was detailed in the book, The Big Short, made into a movie. So when he says we are witnessing history in the stock market, that's not a good thing. People are listening. Burry was specifically referring to stock valuations being so high currently that a reversal or a big sell-off is on the way. And he likened it to, quote, the scene of a bloody car crash minutes before it happens. Now, when or whether it happens remains to be seen. He's not the first to have thought this, and it hasn't yet happened. But if we can just tweak Burry's quote, I think it becomes apropos to the global situation going on today. And so I'd say we are witnessing history, and it is not a good thing. We are witnessing history. It is not a good thing. War and violence waged by authoritarian leaders, destroying communities, killing countless people, driving up energy costs and inflation, widening the divide between haves and have-nots, all on a scale that few of us have seen before in our lifetimes. We are witnessing history. It is not a good thing. At UCF, as responsible investors, we keep before us a vision of a just and sustainable world for all. That vision seems to be largely obscured these days, and that means now more than ever, we need to invest in ways that deeply reflect our faith values, that are rooted in God's care and love for the creation and the created. We are witnessing history, and to simply stand by is not a good thing. Instead, like all of your churches and organizations, we are endeavoring to employ our God-given talents and assets together to move the needle toward a more just and sustainable world where people and planet can thrive. That's my prayer, and that's our mission. Let's go to the next slide. In today's town hall, we're going to share how we're doing this work through sustainable and responsible investing. Kelsey Rose and Matthew Ilian will bring updates of our organization and response and our responsible investing program. And then Matt Wagner and Stacy Pettis will be in dialogue with Minoti Dhanaraj and Vanessa Wong around our funds, capital markets, and the overall economy. Working, by the way, behind the scenes and these slides are the marketing communications team of Debbie Wibowo and Adam Sank. And before we launch into the updates, let's take a really quick poll. If we can go to the poll, we're curious to know how you or your church organizations share and receive information and updates. And in particular, we're curious to know what social media platforms are you utilizing. So if you would go ahead and mark the ones that you're using, you can do more than one here. As you make these selections, I'm going to hand it over now to Kelsey Rose of our institutional relationships team, to go over the results and bring the organizational updates. Kelsey?
Thank you, Charles, and hello, everyone, and thank you for answering the first poll question of the evening. Let's take a look at the results together. All right, it looks like Facebook is the most frequently checked social media platform for viewing organizational updates, or maybe that's where you find yourself spending the most time in general. It also looks like people are checking LinkedIn and YouTube, and maybe some other platforms as well. Interesting and very helpful for us to know for our communication efforts and perhaps for your own organization's communications. And I would be remiss if I did not mention that if you're not already, make sure to follow UCF on the platforms you enjoy most for updates and news. We tend to have the most engagement on LinkedIn currently, so go ahead and follow UCF there too on LinkedIn if you are ever active in that space. And with that, let's jump right into a few organizational updates. All right, our 2025 annual report is now available. The report is an excellent summary of the past year, and it's filled with stories and highlights of our community and partnerships, our financial stewardship, and examples of our values in action throughout the year. And you can access the annual report through the link available in the webinar chat and on our website. And we will also send you a copy of the slide deck from this town hall after we conclude, and you can find links to all of the resources and updates in the slide deck. And another important update is that UCF joined with other values and faith-based investors in sending a letter to the Dollar General CEO expressing concerns over a significant rollback of diversity and inclusion efforts for the company. The letter also highlights the potential long-term impacts of this rollback on the company's brand, growth, and shareholder value. And this is a great example of when UCF is able to collaborate with like-minded investors and justice advocates, that we can engage companies on issues that are important to and also alongside the ministries of those we serve. You can read the article on UCF's decision to write this letter to the Dollar General's CEO and read the letter through the link available in the chat and on our website. And then last month, UCF was grateful to be a co-sponsor of the 2026 Earth Summit put on by the UCC. You can read more about this event that took place last month in the link available in the webinar chat and on the UCC website. The UCC as a denomination has a notable legacy of environmental justice and advocacy work, and these commitments and gatherings such as the Earth Summit continue to inspire UCF's work for environmental justice through investing. And also, if climate action is important to you and your congregation, this is an annual event, so be sure to stay tuned for information on next year's Earth Summit, which usually takes place around Earth Day in April. And next up, have you ever wondered, how do I make an account-related request at UCF for my church or organization? Well, the answer is we have a form for that. Our team has been diligently making updates to client account forms to use for deposit or withdrawal requests, creating new accounts, or making changes to asset allocation, and all of those types of account needs. You can find the newest version of the account forms on the UCF website. And we are linking the webpage here in the webinar chat to find all of our account forms. And to ensure that you're using the most up-to-date form, we highly encourage you to go to the UCF website and download the form that best fits your need. And lastly, UCF is one of the 5 financial ministries of the UCC, and we all work collaboratively to support the mission and ministry of local churches, judicatories, and UCC affiliated human services organizations. Each financial ministry often has their own learning opportunities and events made available to all, so be sure to check out each of their webinars and events as they come up. Just here on the screen, we mention a few of these events for you, and I hope you'll check them out. And with that, that's a wrap on organizational updates. Now I'm excited to welcome Matthew Illian, our Director for Responsible Investing, to walk us through updates on the responsible investing work at UCF. Hello, Matthew.
Hey, Kelsey, thanks so much, and greetings to all of you joining us. In the past, we've spoken about the attacks on shareholders, and let me be clear, I'm talking about political attacks on active shareholders. So the powers that be have no problem with shareholders that are passive and want to rubber stamp every decision that corporate executives make. So, and these attacks have been marginally successful and have impacted UCF, as you'll see in the results of the shareholder proposals that we filed, which are listed on the next slide. So in this slide, we have the 5 shareholder proposals that we were involved with over this past year. And at United Health Group, we co-filed a resolution that was seeking a report on patient care. And the company responded by saying it wasn't going to put this resolution to a vote. Well, in the past, a company would have to request a decision from the SEC before they could admit a shareholder proposal. But this is no longer the case today. So today, new and more lenient rules allow a company to decide to omit a shareholder proposal without the SEC's involvement. And so unfortunately, this resolution won't be going to a vote. Then we turn to Pepsi. We co-filed a shareholder proposal there seeking that the company address concerns over some troubling human rights violations that were making public media in India and Malaysia and Russia. And the positive news here is that the company, Pepsi, did decide to allow this to go to a vote, but unfortunately the resolution only received 16.5% support. In the past, this type of resolution would typically get support from at least one of the big asset managers in the US. I'm thinking about BlackRock, Vanguard, State Street. But in the current environment, this doesn't seem to be the case. Over the last 2 years, we've seen these large asset managers walk back their support from nearly every type of environmental or social concern that active shareholders like UCF seek to address and risks that we seek to address. Then we turn our attention to Alphabet. This is the parent company of Google. And we have co-filed a resolution there on data privacy concerns. This will be going to a vote on June 5th. And we do unfortunately expect that the vote results will also be quite low this year for similar reasons that we described at Pepsi. Thankfully, it's not all bad news. The 2 resolutions at ICE, which runs the New York Stock Exchange, and Incyte, a pharmaceutical company, both led to positive withdrawal agreements with these 2 companies. And in both cases, the companies decided that they would give us, as investors, the information that we were seeking. So we didn't even have to go to a vote. We were seeking more information on their lobbying expenditures. And we argued that it's a risk to investors to hide these dollars that are being used to influence policy decisions. So why did these 2 companies settle with us rather than letting it go to a vote or omitting the shareholder proposal? I think it's because they know that lobbying transparency is a nonpartisan issue and that the company might have suffered an embarrassing result if they tried to fight us on it. So that's all for the review of our shareholder proposals. I now want to turn to talk about our bond portfolio. So in this next slide, bonds can be considered by some to be maybe the less exciting of the asset classes. Bond investors pay interest and generally don't have the exciting updates. But I'm here to tell you that's a big misconception. In many cases, bonds offer the greatest impact. In fact, at UCF, over a third of our bond portfolio, which is over $100 million, is invested in green and blue bonds. Green and blue bonds are bonds that use proceeds to finance efforts to reduce greenhouse gas emissions or protect land and water ecosystems. Kelsey mentioned that we will be sharing the slide deck and the recording afterwards. And if you can click on the links here to give you, if you want to read some examples of some of these green and blue bonds. For example, some of the green bonds that are highlighted are at the World Bank. And then also at the Connecticut Green Bank has issued green bonds that UCF is invested in. And then also a blue bond that's issued to support sustainable fishing in the Galapagos Islands. So I encourage you to take a look at that blog post at another time. My last topic that I want to cover is a podcast recommendation.
The company pulled.
If you haven't yet listened to the Just Investing podcast, I'm here to tell you that we just recorded a really great episode. I may be biased because I think every episode is great and worth your time. But on this one, we welcome Ben Cohen. Ben's the iconic co-founder of Ben & Jerry's, and he came on the show to share how Ben & Jerry's came to be owned by a company that does not share the company's social mission, and why he is now fighting to free Ben & Jerry's and get it back to independent ownership. We cut a very short clip that we want to share with you today.
The company pulled out of the West Bank, the occupied territories, and Unilever got a tremendous amount of pushback for that and ended up usurping the power of the independent board and ended up selling the rights to Ben & Jerry's to an Israeli, which they couldn't do. That created some problems. And anyhow, at one point, Unilever announced that we're going to sell our entire ice cream division, which is about 100 brands around the world. And Ben & Jerry's was part of it. And we had been having, since that time in 2021, there was that conflict with the board over the West Bank. They continued to silence and muzzle Ben & Jerry's when it tried to speak out on issues of justice. Like calling for a ceasefire in Gaza or supporting students' right to protest. Jerry and I went to Unilever and said, if you're going to sell off the whole ice cream division, why don't you just separate out Ben & Jerry's so we can find some socially aligned investors to buy it and solve this problem? They weren't willing to do that, and so eventually they spun off their whole ice cream division into the Magnum Ice Cream Corporation. And as soon as Magnum became the owner, they fired the CEO, who had been a 30-year employee, because he was listening to the independent board and actualizing the social mission. And then they went and illegally dismantled the entire independent board. Clearly, Magnum does not have any interest in maintaining the social mission, and that's why we need to free Ben & Jerry's and get it owned by an entity that supports it.
So that's a short snippet, and I encourage you to listen to the entire podcast. It's about 30 minutes long, and Ben Cohen was an excellent guest. When you do get the slide deck here, you can click on the Apple Podcast, the Spotify link, and that'll take you right to the podcast, or just search up the Just Investing podcast. I really enjoyed the time we got with Ben. Okay, so now we want to turn to some trivia questions for the group, and there will not be you're not going to get graded on this if you get it wrong or anything like that, but we thought these were some just interesting trivia points that we wanted to make to get you thinking about some of the issues that we think about in investing your portfolios. So the first question is, what is the projected change of U.S. electricity demand over the next 10 years? And the answers, and you can pick one of them. Is it going to decrease slightly, Was it going to stay about the same? Are we going to see a cumulative like 2% increase, like a marginal increase, a 20% increase, or a 40% increase? So make your selection there. And then there's another question below that, another trivia question, which is you might have to scroll down perhaps, but it says the total value of global capital markets is measured around 280 to 290 trillion. Which asset class is the largest? Okay, again, we get a single choice there. And if you would make a selection on which of those asset classes you think is the largest, we'll speak to both of these in a minute. And while you're selecting that, I'm going to introduce my colleague, our Vice President of Institutional Relationships and overall great guy, Matt Wagner.
Matthew, it's always difficult to follow you on these webinars, and now I have to follow Ben Cohen. So I got my work cut out for me, but thank you, my friend, for that nice introduction. And let's take a look at the responses here that we have. So our folks think that it's going to be so about half of the room thinks a 20% increase, and about half of the room thinks about a 40% increase. And Matthew, which one of those is the actual correct answer?
So, you know what? This is a good dispersion here because right now the projection is 20%. So right now it's been growing at 1.7% a year. Multiply that by 10, that's 17%. But what we don't know is the full impact of AI, which everybody knows is driving electricity demand incredibly. And so it's very likely it's going to push over that 20% number. And so, I think everybody's right on this one, Matt.
Yeah, I totally agree. The general consensus here is that electricity demand is going to go up and going to go up significantly, and how the global economy and how the U.S. economy responds to that will be a major factor as we think about investment strategies as we move forward. And then the second question, the total value, now this is global capital markets, is measured, again, 280, 290 trillion. Our folks think that private equity and venture capital is actually the largest. 51% of the respondents said that is the largest, followed by about a quarter of the crowd thinks public equities. 16% bonds, think bonds is the largest, and they're about the same. A few folks think that. Interestingly enough, 145 trillion of global markets belongs in fixed income. Fixed income is actually the largest part of global capital markets, as listed on this. And public equities closely follows at about 125 to 130 trillion. Again, fixed income 145 trillion, public equities 125 to 30 trillion. Private equity and venture capital, and I'll say this with air quotes only, about 8 to 10 trillion. So it is by far the smallest in global capital markets. So thank you for participating in that poll. Thank you, Matthew, for your updates on the work that we're doing around socially responsible investing. And I would just take this moment to note that as we're talking about as we've talked today about our green and social bonds in the portfolio, and as we think about fixed income, for many of our clients, fixed income holdings, particularly, for those of you that use the balanced funds, that ends up being, 35 to 40% of your portfolio. And we're able to do some really good work there. And you're going to be learning more about that from United Church Funds in 2026. And we look forward to bringing you some more updates about what we're doing, not only on the equity side, but also how we can make a difference in the world on the fixed income side of our portfolios. We're going to go ahead and move on with some investment performance and some Q&A with our investment team about how we've positioned the portfolio given current market cycles. And as we go to the next page, we're going to start off with some takeaways. And we went ahead and put this through April 2026. For those of you that follow markets closely, you know that we've had some fairly significant volatility, particularly in the equity markets, across the first, 4 months and 2 weeks of this year. And the real inflection point was at the end of March, when, as we saw during the month of March, equity markets moved down. They were mostly flat to negative in the first quarter, moved down in the month of March in particular. And then in April, there was a resurgence in equity markets. And so we're going to be talking about a little bit about that tonight. As we note there, through the end of April, the MSCI All Country World World Index, ex-US, which is the international markets, we're also going to talk about, and those are up about 8.5% year to date. Through today, interestingly enough, the S&P 500 up about 9.5%. That ex-US, the MSCI ACWI Index, ex-US, that's the international exposure of our portfolio, up about 12%. Overall, the global markets, that MSCI All Country World Index, which is the benchmark for the equity that we hold in the traditional UCF Balanced Fund, up about 10% for the year, with of course the vast majority of those gains coming in the month of April. We've also seen commodity prices surge. I think that's going to be no secret to anyone. But if you go back to the end of January, oil was trading at around $66 a barrel. It's now about $101 a barrel, I believe. Of course, that has really impacted fuel prices in the U.S. And also, with the closure of the Strait of Hormuz and shipping issues, we've also seen some prices for key agricultural inputs like fertilizer really move higher, which might lead us to food inflation for not only this year but beyond. On the bright side, we've had some really strong earnings reports from companies around the globe, and the March jobs report was really pretty solid, adding jobs and edging that unemployment rate down to around 4.3%. All of that to be said, with all of the volatility that we've had, if we go to the next page, just a quick quote from Peter Bernstein, a noted economist, and he was a vocal proponent of the efficient market hypothesis. And Mr. Bernstein noted that volatility, as we think about the stock market, is often a symptom of risk, but it's not a risk in and of itself. Volatility obscures the future, but does not necessarily determine the future. And so, as we've seen the values of your portfolios move up and down over the course of the first 4 months of 2026, it's important that we remain diversified with our strategy and understand that these some of the shorter term volatility that we've seen because of global conflict, because of trade conflict, and other factors. Those in and of themselves need to be taken as a whole as we think about our investment strategy, and doesn't lead us to knee-jerk reactions at UCF. We have built portfolios for long-term competitive performance. As we look at some index returns as of March 31, 2026, I just want to offer up. Of course, this is through March 31, right? So the numbers that you see in the left-hand columns for Q1 and year to date, those are going to be negative. They reflect the performance through Q1. Of course, we've talked about we've had a major bounce back in Q2 2026. But if you look at those longer-term performance track records for the various indexes over 3, 5, and 10-year periods, again, it has really paid investors to stay invested through some of these short-term blips in the market, and benefit from the earnings power that we've seen in global equities. Also of note, just at the bottom right, difficult to see, but we ended the first quarter with the 10-year Treasury at about 4.3%. That has ticked up to about 4.4%. And this last week, the U.S. Treasury sold 30-year bonds above the 5% mark for the first time since 2007, before the global financial crisis. That 5% yield mark was sort of a little bit of a demarcation point as interest rates have continued to rise, and kind of shows that investors are looking for safer asset classes with some of the unknowns related to global equities and some of the volatility that we've seen. As we go to the next slide, I want to bring in my colleague, Stacy Pettis. Stacy, welcome to the webinar. Stacy's going to walk through the next couple of slides and then introduce our first question for our investment team. Stacy, take it away.
Great, thank you. Hello, everyone, and thank you again for being here. As we are taking a look at this slide, I just want to set the context of our awareness of the conflict within Iran that started February 28th and the significant impact it's had on the oil markets as Matt just mentioned, as well as the shipping of important goods like agricultural fertilizer. The chart on the left shows us that the average US gasoline prices have increased over 32% during the month of March. Although that is the domestic impact and the US is a net exporter of oil, there are even greater impacts to developing economies who are net importers. In the chart to the right, we can see that historically there have been crises in the past. The first line, the Suez Crisis in 1956 to 1957, there was 10% of the world's oil supply was disrupted. Yet there was 35% available spare capacity throughout the world. Yet at the bottom of the chart, we see the current conflict in the Middle East has disrupted 20% of the world's supply, and there is zero available spare capacity, which is a very concerning data point to see. As we flip to the next slide, the charts illustrate the historical negative correlation between oil prices and equity markets, specifically the S&P 500. I want to bring in Manothi Dhanaraj from our investments team now to ask a question related to these events. Manothi, thank you for joining us.
Yes, thank you.
Can you share with our audience some of the ways the current conflict impacts our allocation strategies?
Sure. So hopefully you all can hear me okay. I think my signal is going a little in and out, but thank you for the great question. So conflicts in the past, such as the current ongoing Russia-Ukraine war, hasn't really affected the stock market that much as we've seen over the past 4+ years. Additionally, oil going up doesn't mean that stocks always go down. So if it's related to demand increases due to a growing economy as well as increased consumption, stocks could actually rise. On the other hand, as a result of the current conflict, as you noted with Iran, there's a big supply disruption. And because of the closure of the Strait of Hormuz, 20% of the global supply is currently being constrained. So we've seen Brent crude oil go from approximately $60 a barrel at the beginning of this year to peaking around $118 and now hovering around $100. This in March led to a drop in the stock market globally. But then as there was a de-escalation of the war and the conflict with Iran, we started to see in April the stock market coming back. Beyond just the de-escalation in the war, we also saw strong jobs growth, retail sales, and earnings data that made the markets go back up. In regard to your question on our allocation, when February 28th hit, we made a decision to mitigate risk by reducing our equity exposure. And then to remind you all as well, we do have active investment managers. And during this period of time, they've been a lot more nimble in terms of their sector and regional allocations. So some of the areas that we may see some impact coming into the summer include travel and discretionary spending, as well as some more impact towards those economies, like you noted, Stacy, that are more exposed to food and fuel imports that are getting impacted by this conflict. So our active managers, like I said, are being very nimble and active in this environment in terms of understanding which areas to be investing in.
Thank you, Manothi. It's great to know that these tactical decisions are being made on our clients' behalf, and that so much thought is going into how we continue um, to build our portfolios and strengthen our returns for everyone that's invested. I want to hand over the next question to Matt Wagner.
Thanks, Stacy, and thanks, Minothi. Great to see you. And it'll be really interesting for us as we talk about some of these higher commodity prices and how that's going to impact folks' pocketbooks. I mean, as we know here, the gross domestic product, or the GDP of the U.S., consumer spending drives close to 70% of that. And so as we see consumer spending habits change due to higher commodity prices, it'll be interesting to see how that impacts the commodity, or excuse me, the economy. Speaking of higher prices, we're going to switch gears and talk a little bit about inflation. This is one of the questions we get most often as we're doing portfolio reviews with clients, is just the inflationary impacts on portfolios. And we'll often share with clients that investing in the stock market has been traditionally a really good hedge against inflation. But earlier this week, the Bureau of Labor Statistics came out with what we'll call a healthy increase in inflation data, with the Consumer Price Index, or CPI, rising in a seasonally adjusted 0.6% to a one-year pace of 3.8. Our clients might be more familiar with something called core CPI, which excludes food and energy, and that rose to a pace of about 2.8, which is well ahead of the Fed's target of 2% inflation. So again, stock market investing over the long term, often considered one of the best hedges against inflation. But how does this higher inflation affect our overall investment strategy?
Well, thank you, Matt, and happy to be here. You are right. Over the longer term, equities have proved to outpace inflation. That said, in the shorter term, inflation and stocks can have a negative correlation. So if higher inflation leads to higher interest rates and higher input costs, the price to earnings ratio, especially for high growth companies, can get compressed. As shared in kind of prior town halls, we hold a portfolio of very well diversified assets across different asset classes, sectors, and regions to really mitigate the risk of inflation. Our active managers are especially important during these times because they're able to select quality companies with pricing power into their portfolios. Additionally, we have been investing in real assets such as real estate, which can also mitigate inflationary pressures during these times.
Thank you so much, Benothi. Really appreciate it. And as I turn it back to Stacy for the next question, let me remind the audience that if you have a question for our team, you can use the Q&A feature on the webinar. If you don't see the Q&A box at the bottom, as Charles noted at the beginning of the call, click on the More button, and then that will bring up a couple of different options, and you can click on Q&A and ask questions, and we'll try to get to those at the end. Stacy, go ahead with the next question.
Thank you, Matt. As we flip over to the next slide regarding the dispersion within AI, this chart illustrates AI industry performance since 2023. We can see that there were huge returns coming from the hyperscalers and semiconductor industry. Currently in 2026, we are seeing investors shifting to dig deeper into what's referred to as the pick and shovel companies, who are developing infrastructure, components, and supplies needed to drive artificial intelligence. I'm going to bring in our other colleague from the investments team, Vanessa Wong, to ask this next question. Vanessa, welcome. Can you please share with our audience our view on the investment opportunity in AI hardware, semiconductors, power generation, and metals and mining needed for this AI advancement?
Thank you, Stacy, and great to be here and see everyone. And what a great question. What happened in 2026 so far is that Magnificent Seven spending on AI and the associated buildup of data centers have become such an immense and popular trade for investors that it's also pulling other AI related industries up with it. leading to a broadening of the market, although still very concentrated. And this trade has particularly benefited semiconductors year to date, with several chip producers' price returns looking particularly dramatic, especially in April following the V-shaped recovery of the US markets. And it's not just in the US, we're also seeing increasing concentration in emerging markets with sizable returns from semiconductor manufacturers and memory chip producers in Taiwan and South Korea, who are also supplying the US Magnificent Seven companies. And furthermore, we're also seeing strong demand leading to high commodity prices for industrial metals and mining. So we're talking about materials like aluminum, zinc, lead, copper, nickel, all of which are essential inputs for data centers and the electricity grid that powers them. So in many ways, this is a rational investment theme, right? So if AI is the next gold rush, then it makes sense to own the picks and shovels behind it. And the fundamentals of these AI hardware companies support it as well. So for the foreseeable future, as these large US tech giants are locked in an arms race of AI spending, that requires real physical infrastructure, a lot of which are in short supply right now. So we're talking about the need for more copper, more chips, more power, more high bandwidth memory chips, anything that helps, AI compute and AI networking. The earnings results from many of these AI hardware companies have reflected that demand, that strength, with solid double-digit sales growth and in many cases strong margins and strong balance sheets. And because of this AI demand, they still have real pricing power. So some analysts have argued that there is still a lot of remaining upside for these AI hardware firms. I think the key question is the sustainability of these earnings for these semiconductor companies, as well as, the question of timing, when this trade momentum will subside. The market has clearly priced in a lot of optimism already. So investors are now asking, as they ask the Magnificent Seven company when they do their analysis, whether this AI adoption is happening fast enough and at sufficient scale to justify this level of spending and valuation. But for our portfolio, of course, especially in our equity portfolio, we have benefited and we have participated in this AI opportunity, but we also remain diversified and avoiding the temptation to chase short-term momentum trades aggressively.
Great. Thank you so much, Vanessa, for sharing so much related to this industry. We've all been employing new ideas and ways of using AI, and to hear more about the fundamentals behind that and the infrastructure that's needed in order to maintain this is really important. And so we look forward to hearing more about how this is incorporated within our investment strategy. I'll turn the last question over to Matt.
All right, thanks, Vanessa. Welcome. And we had one question in the Q&A that I thought I would just pose to you right now. Just the first question of the night, because it had specifically to do with that last slide. And one of our attendees asked, "What are, or can you define the hyperscaler term that we use for AI?" Yeah.
Yeah, absolutely. So this refers to the Magnificent Seven companies.
Yeah, that Mag 7, the Googles and Apples and Microsofts and Teslas and those huge mega cap tech companies that are driving all of the much, not all, but much of the capital expenditure spending to support this new AI infrastructure that is being built out. Thanks, Vanessa. So one more theme here that we're going to talk about today, and that's we're going to end on a bright note, and that is U.S. earnings. So near-term earnings have been driving stocks higher. We got some earnings reports at the end of the first quarter, and gosh, I mean, the investors really responded to that, and that really drove the S&P 500 up significantly. Just in the month of April, the Russell 2000 was up. The Nasdaq was up, I think, over around 25% just for the month. So I mean, significant money flowed back into equities, and much of that was driven by some of those earnings reports that we had seen. There seems to be some consensus that trend is going to continue. So can you share your thoughts with our viewers on U.S. and global earnings and some of the factors we might continue to monitor as we're looking at the growth and health of those earnings?
Sure. Yeah, another great question. Indeed, corporate profits have been extraordinary, and this supports or partially explains the all-time highs we are seeing in the S&P 500 every other day, I believe, including today as well. So what you can see here on this slide is the Q4 2025 results, which are great, but I can also share more about Q1 2026 results now that the large majority of companies have reported. And again, for Q1, the results have come in better than expected, beating analyst forecasts. So this earnings growth in the US, another trait about it is that it's broad-based. So we're not just talking about tech companies, the large tech companies. We're not just talking about the semiconductor companies that I mentioned earlier. We're not even just talking about oil and gas companies benefiting from the supply shock driving these numbers. We're also seeing solid contributions from other sectors, including banks, consumer discretionary companies, industrials, materials sectors. And in many cases, that strength has been supported by their financial statements. We have seen margin expansion, which tells us that these companies are not just growing their revenue, but doing so more efficiently. Outside of the US, in terms of global earnings, the picture has been slightly more mixed, but I would argue still very positive and constructive. European earnings so far for Q1 have generally been in line with expectations, and emerging market earnings have also exceeded forecasts, helped in parts of the strength in semiconductor and memory chip producers, again, in Taiwan and South Korea, as well as commodity-related companies. And this has been an important source of support for global earnings overall. So this may come to a surprise to many of us, despite the closure of the Strait of Hormuz and the subsequent energy shock, despite that many of these emerging market countries are net oil importers, we're still seeing this rosy picture. So that said, we are continuing to monitor several risks closely. What is top of mind for investors is, of course, the Middle East conflict and whether the US and Iran can come to a resolution soon and stop this war. The longer the Strait of Hormuz stays closed, the longer oil stays above $100 a barrel, the more inflation becomes a persistent problem. So we're talking about gasoline, but also talking about business operating expenses, grocery prices increasingly become even more unaffordable for the average American consumer. And as we've seen yesterday, when the inflation report came in, April consumer price index is showing an increase of 3.8% over 1 year, the highest in almost 3 years. But the unemployment rate has stayed steady. So the question is, if inflation remains sticky, if it remains stubborn, the Federal Reserve may need to take action to increase interest rates. And the market is indeed pricing in expectations that the Fed is going to hike interest rates. This will increase the borrowing costs for companies and lead to a slowdown in economic growth, most likely. And of course, as inflation remains persistent, this will further weigh on consumer spending and consumer demand. So overall, we're monitoring geopolitical risks as well as the path for central bank policy rates and remaining cautiously diversified.
Thanks, Vanessa. And of course, this comes in the backdrop of the Senate confirmation of Kevin Warsh as the new Fed chair, and his previous comments about wanting to lower interest rates in an environment where actually rising interest rates may be the path forward. So, Vanessa, thank you so much for sharing your expertise with our group, and Manothi, thank you as well. I want to hang on to both of you for just a moment as we go ahead and move directly to the Q&A. We have some excellent questions, and so we're going to take just a few minutes. We usually try to keep the webinars to about 45 minutes, so we're going to take the next, say, 5 minutes or so and try to get to as many questions as we can. I want to start with a question from Arthur Clement, and Art, great that you're on the call. Art is a member of the First Congregational Church of Atlanta that was on our cover page, so thank you for allowing us to highlight your church. And Art's question is, what impact does higher inflation have on the fixed income bond portfolio of the portion of the portfolio? And Manothi had already responded to this question and said, we have actually, and shared our strategy, is that we've been reducing duration across our fixed income holdings and continuing to try to move up in quality given some of the risk to fixed income related to higher inflation. So we are well aware of it. We have the vast majority of our core fixed income, or our total fixed income, it falls into a core strategy with two excellent managers, the pension board's fixed income team, which has done a terrific job for us, not only with our more traditional fixed income, but also our beyond fossil fuels fixed income. They've become experts and specialists in green and social bonds and have done great work there. And then also one of our larger bond managers, Nuveen, also does an excellent job and is able to be nimble in this, in what is a little bit of a moving target related to fixed income, related to inflation. Scott Berghoff also asked a great question. How do you balance power infrastructure investments with the objectives and values around beyond fossil fuels? Such a great question. We will, on a broad scale, we will continue to use corporate engagement as a way to interact with companies that are in the portfolio to be able to understand responsible power generation and power infrastructure related to the increasing demand for electricity. And Manothi responded to his question by also noting that we're investing in areas redirecting capital from legacy fuels to renewables with infrastructure for electrification. So it is an all of the above policy at UCF to be able to continue to meet our values around climate justice within the portfolio, and also continue to generate a competitive return in the portfolio. A couple of other questions that have come up. Wells Frice asked a question: have you considered adding a position in commodities and or gold? We do not own commodities directly in the portfolio. I don't know if Manothi or Vanessa wants to take a crack at that. That is not something that we've traditionally done in the portfolio, although we do own positions in the portfolio that would benefit potentially from rising commodity prices as well. And then another question from Steve Hotchkiss. With the increase, this is a great question. With the increase in oil prices, what changes have occurred in the volume of oil and gas sold? So fuel consumption in the U.S. is typically considered inelastic for the most part, particularly in the short term, meaning that folks still have to commute, come to work. They're going to drive their cars about the same way. However, over longer periods of time, folks can make longer term decisions that may impact the volume sold or the consumption, less vacations, less travel. Manothi mentioned that in one of her responses to some of the impacts of this higher inflation and higher gas prices. Could also impact the auto industry and the types of cars that are purchased potentially in the future. So great questions all around. Just a couple more that I have here. Reading these for the first, I always like to do these live, reading them for the first time. How have the macro views you are discussing specifically affected your investment decisions in the last quarter? As an example, weighting given to individual managers as well as assets managed by UCF directly. I want to be clear in saying that our outside managers are doing the daily trading of the portfolio for all of our assets. So we intentionally hire managers that have a long track record of success related to performance, as well as an ability to play by our social and climate values lenses. But we certainly can make decisions, as Manothi mentioned, we can make decisions to overweight and underweight managers based on a specific style or strategy or a specific asset class. So Stan, I'll be happy to respond to you a little bit more just with the time constraints that we have tonight. I'll be happy to reach out to you. If you want to email me, you can directly, matt.wagner@ucfunds.org, and we can kind of flesh that answer out a little more because it's an excellent question. And then last but not least, Jim Dewey asked, is there a base amount of funds for a local church to be invested with UCF? Great question, Jim. UCF, while organizations of our size typically have investment minimums of, say, 6 figures or $250,000, United Church Funds is intentional in keeping our investment minimum to $1,000 to open a new relationship with UCF. And the reason for that is that we want our platform to be available to every single church and institution across the UCC and beyond, regardless of your size. If you're just starting an endowment and you'd like to think about long-term investing, our team is here to help. For those clients that do have significant portfolios with us already, if they'd like to start new accounts, it offers an opportunity for them to start smaller accounts to fund scholarship programs and memorial funds and different accounts like that outside of their long-term endowed assets. So great question, Jim. And in closing, I'd just like to thank all of my colleagues, both on camera and off, for a great webinar tonight. I'd like to thank all of those that participated with us tonight. For those that registered, you're going to get a link to the recording of this webinar, which should arrive tomorrow. It'll also be available on our website. I encourage you to share this with other members of your investment committee or other folks in your church that you think would find this information valuable, not only just about our investment work, but also about the work that we're doing within the investment platform to make the world a better place. So with that said, I want to thank everyone for participating tonight. Wishing you a wonderful evening. Take care.